So one of the questions that I always get is, should I just buy a multiplex myself in Alberta? So I'm just going to go through some of these performas of multiplexes in Calgary and Edmonton and my underlying analysis of whether the numbers that you're seeing are actually accurate or false. So I got an email from an investor saying, please find the performas of Calgary, Alberta multiplexes, advice per your insights and experiences. So we're just going to go here and move this guy here. So I'm just going to leave some notes here. So some of the notes that came from this email are as follows. These are some additional costs that would be included outside of whatever you're spending on the individual deal. So that's good to know. So there's definitely, like, appraisal 4,500, 2,750 for phase one, 10K approximate legal fee, 5K, and this is again coming out of the realtor there who's saying that. And I would say, like, application fees probably going to be, depending on the size of the project, anywhere between 2,500 to $6,000. So let's just call it $2,500 for now, and then any other costs from CMHC just usually as the insurance premium gets added over there. There is closing costs. So usually you'll still have like title insurance and that stuff. And I guess you're going to be traveling to go see the project. Wow. So you're going to spend 10K to be part of the bill. That's okay. I guess you would do that. For title insurance, you're probably looking at least $3,000. At least that's what we're seeing. So this is what it's going to be, I guess, across any of the projects that we are looking at today. And obviously the broker fee will be subject to the individual project. So we know total costs before we get to that is going to be about 38K on anything that you're buying that's going to be out of pocket, not included in your down payment amount. So what are some of the numbers that we got? Let me just pull that up. Okay, perfect. So we're being told rental income, you've got 3 beds, you got 1 beds. You've got number of units, you got 4, you got 4, you got $3,000 a unit, $1,650 a unit. This is what they're advising is the case. So we're gonna go through and say, okay, cool, this is what your total monthly rent is gonna look like. So this is rent, monthly, and then we'll go annual times 12. So this is how we get sort of the total rent amount. And it's interesting because I guess one of the first things that I see off the bat, especially in this proforma when I'm looking at it, is you can see that they've got property taxes, property insurance, utilities, repairs, property management, miscellaneous, and they've got various amounts per unit per year to get the total amounts that they have. So let's take a look. So they're saying the vacancy rate is 4%. So we're gonna go vacancy 4%, or vacancy rate. You go 4%. You go, okay, it's gonna take this times this, and this number is gonna be a negative to get to your effective gross income. So a lot of what they explain in here is that they're using CMHC benchmark numbers for some of the stuff. Whether that's true or not, we shall see and find out. So we are getting a different amount of effective gross rent than there. So 23,200, 23,400 times it by, okay, 4.5%. We are ending up with the same gross operating number. Great, we are happy. This is what the total rents are that you can expect to achieve, for this property, is what they're stating in this case. And then they're saying, okay, let me just take a look at some of the other items. So property taxes, again, you're gonna have to do some due diligence to kind of find out exactly what you're looking at for those, but they're saying it's 15,000. Property insurance, We're going to dig into how we get that as well. So they're saying 4,000. Oh, they're saying utilities is 0 because they're saying all inclusive. Well, let's see if that's right or wrong. Repairs and maintenance, they're saying $500 a unit. I disagree. Typically, you're probably looking at $750 to $800 a unit. So I'm gonna go 800 a unit. I guess they're arguing it's 500 because it's built brand new, but they're still the standard benchmark numbers. So I'm gonna go with 750 because if you're going to look to refinance this in the future, etc., this is sort of the. I guess we can use an average number of the two, and just say this is what it will be. 750 a unit per year. So we're gonna do this times the number of total units, which again we need to equal sum total number of units, 8 units. Okay, repairs and maintenance. No, it's not. It's the total amount per year. Divided by 12. Not by 12. You want total 6K. All right, so we're about 2K difference already here in what we have, and then you have property management. Again, the CMHC benchmark is 5%, but this isn't accurate. You're probably, if you're coming from out of town, you are not going to be hands-on. You are literally going to have property management deal with everything. So what property management does on top of your standard repairs and maintenance is they will charge a markup of anywhere between 10 to 20% on any sort of repairs. Really, this repair number will probably go even higher than this. And property management, again, they will charge for leasing out the place. So you will be paying 1 month's rent, typically as a leasing fee. And then for any coordinating of trades or any issues and any other stuff outside of just standard rent collection that your 5% will cover, especially for a smaller building where it's like about 8 units, you're realistically going to see somewhere closer to like 10% because you will usually have property management and salaries when you're underwriting a multifamily deal. So 10% is probably more representative in this case that you're going to be paying for property management. So as you can see, this is almost double what they've put in there. And then they've got miscellaneous of $10,000. So one could argue some of the charges you'll have are like internet. You'll have internet, snow removal, landscaping. That are all costs that you'll have there that you'll need to take into consideration. Snow removal, there's also salting. And especially as it snows a lot more and it's a lot colder out in Alberta, you're going to definitely have to factor that. So let's just say they've captured all these expenses. Your total that you're looking at is going to be, from an expense standpoint, again, assuming that this is all like, tenants paying all the utilities, $56,315, leaving you with a net operating income of 213,156 minus 56,315, which is 156,840. So when we look at the spreadsheet here, what they calculated to what we have, we're seeing that the net operating income is off by about $12,000 to $13,000. They're saying the cap rate that you would achieve is about 5.12, and the amount of money that you need in order to do this deal. Let us see, where is the amount of money that you need to do this deal? They're saying the down payment you're going to need is $165,000. So the down payment is $165,000 here. And then I guess some of the other costs, other out of pocket. Again, this down payment is just based on having 5% of the purchase price. So the assumption here is that the purchase price here is $3.333 million is what you're buying it for. This is your other out-of-pocket cost, which we go over here, is the $37,750. And what we determined over here is that we would have a mortgage, which they've outlined as 95% loan to value, is this times 0.95, 3,135,000. What we determined here is there's also the broker fee, which was going to be 1% of the project cost. So for the sake of that purpose, typically your mortgage broker is going to charge you that based on your mortgage. So it's going to be your mortgage times 1% that you're going to have as well. So now 31,200. So your total all in is equal to this 234,100 amount that we have here. And then we want to kind of know what the mortgage and after cash flow will be. So I'm actually just going to pull in a calculator that I have for determining mortgage payments. So I'm just going to move that over into here and create a version of it. So I toss this in. So basically for $1 million, they said the interest rate was going to be 4.25%, which is right over here, and a 50-year amortization. So we're going to go 0.0425, and the mortgage is a 50-year mortgage. And then it's using today's date, so it's going to calculate that out. But the mortgage amount that we are determining is going to be this 3,135,000. Here is the total amount that's going to be outstanding. Again, you're going to end up having, this is the summary tab. You're going to have mortgage payments, and it's equal to the sum of all your mortgage payments that you're going to have. So over that 12-month period, you have this much. Your true net cash flow is looking more like 5,454.42, and principal pay down is going to look on an annual basis more like this of 12,262, so 18,506. So your total is going to equal the sum of this divided by this. So your ROI is taking the profit, the cash flow that you'll get from this, plus the principal pay down, divided by down payment, your out-of-pocket cost during the construction, and the broker fee. And so you get a 10.2% return. And one would argue this isn't the best case scenario because we're utilizing their one-bedroom rents of $1,650 and three-bedroom rents of $3,000, with this property being all-inclusive. So high level, this would basically say this project would actually return 10.24% versus what they're offering, where they're saying, you know, the cash on cash return is 11.24% and a 22% overall return. Your overall return is actually 10.4. Your cash on cash would actually just be the 5,000 divided by this, so it'd be less than 2% or 2.33. So if you're looking for cash flow, this is definitely not the place. There's a lot of other options where you can get it. And again, it's just due to the size of this property. We'll analyze the next deal as well. But basically, you're doing all this work to make $23,960 annually. If everything goes well, your cash flows are pretty tight. So if you do have something go wrong, and in later years you will have other stuff come up, this can go haywire. But I guess the easy assumption that you can kind of question for most of the time is like, sure, we change the property management, and again, you're out of town, so you are going to have that. I'm giving them the benefit of the doubt that the miscellaneous costs are going to include all these other items. And the property tax, I'm assuming they have it right, but you know what? I would say roughly this is what property taxes look like. Insurance, if you get a really good deal and it's a brand new build, maybe they're going to let you get away with $4K. Typically, this is what you will see because of replacement costs and stuff like that. But depending on if it's in a flooding zone, depending on how much snowfall and other issues happen in that area, depending on the area where this property is, this insurance cost could double and effectively wipe out any sort of cash flow. So if we went to $8,000 a month or a year, your return basically goes to 8.5 overall with cash on cash of 0.62 or basically no cash flow. So again, that's a risk that you're subject to for that. But I guess the biggest inputs that we can question on overall basis is what is the rental income? Again, this was for a project that was focused on in Alberta and Calgary. So what we're going to actually do is go to the rentals.ca national rent report. And, you know, this is a really good reference because it takes all the rental data that you see across all markets. And you can just kind of question some stuff, right? So over here, you can see that Alberta has actually been going down quite a bit. So it's gone down 6.5% and in Edmonton, 3.5%. As I've sent out in a previous newsletter to our investors, the great, I guess, why people like Alberta is you can build really quickly. But Alberta is a very boom-bust economy. So when a lot of people move over there because they're getting a job or whatever, demand for rentals skyrockets, rents go up. And in Alberta, there is no rent control, so you can annually bump the rents up. But also when people leave, there's a lot of vacancies, tenants can demand that I want my rent down, or they'll just move elsewhere. And so that's why, unlike Ontario, where you've got rent control and limitations, it creates a sticky floor on pricing. Plus in Calgary and Alberta, in general, there's a lot less red tape, so you can build a lot more units that come up to market. And so during the early days, when you own something existing and there's so much demand, it's cool because you can refinance and pull a lot of money. But if you're doing a build project and now a lot of build projects are coming up, you're going to see rents continue to fall down. And if there becomes less demand in Alberta, you're going to see your valuations actually drop and you're going to have to put more equity into the project. So obviously this report is really great for you to analyze anything and have a better understanding. Again, it's going to really cover, 1 to 2 beds. We're going to go and say, okay, let's just see what the year to date looks like here, and we can see all this stuff here. We're gonna go Calgary. So we can see the Calgary 1 bed right now as of November was 1,539. So what does that look like when we compare it to what we analyzed? And what we have here is 1,650. So the real answer is the rent is probably going to be 1,539 because we want to be conservative. We don't know if this rent might actually go down even further. So that's what we can expect. And then as we determined that this rent that they had put in was 1,650, so this rent is actually divided by 1,650, which is the rent that they've assumed here for the 1 bed. We're going to divide the two and determine that, you know what, this divided by 1,650, so it's actually about 93%. So really, let's do, the rent should be $3,000 and just be kind and say that it's going to move downward in the same adjustment. Usually bigger units will probably go down a little bit further, but let's just say this is what the rent that you're going to have to do. Again, without me changing the 3-bedroom rent, I've only changed the 1-bedroom rent based on what was discussed. You can see that the cash flow gets wiped. Basically, it's $1,000 for the year. Anything goes wrong, you're kind of screwed. You have no cash return and you're getting an 8% return. If I then update this for what I think the 3-bedroom rents would also move in tandem to, you're looking at, and saying, again, we're trusting that there's no utilities and that you're not having to cover some of the utility costs or pay for some additional other costs. You're effectively cash flow negative $7,500 a year. You're basically out of pocket $621 a month. Your principal pay down is 18. You're making 11K, but your overall return is less than 5% and you're negative cash flow. So you're basically tied up $234,000 to lose money each month and just make the principal pay down. You might as well just buy like TD Bank stock. Obviously, if you're investing the same thing with Foundation Capital on a monthly basis, you would get $1,365, and on an annual basis, the cash flow would work out to be about $16,000, and on this amount annually, the appreciation that you would see is about $19,000. So in total with foundation capital, you'd make $35,000 versus the realistic $11,000 that you have here. So hopefully this answered all your questions. If you have any more questions, please shoot me a message. If you like this video, I'll shoot more. So this is of an 8-plex in Calgary. I'm going to do the next video on a slightly bigger building, and maybe that makes more sense. A really good reference also, guys, is just to take the purchase price per unit, divide by the number of units, and you know that this is $413,000 a unit. Replacement cost, if you go on realtor.ca, you can probably find a lot of deals around $200,000 or less for older Calgary buildings that are commanding the same kind of rents. So it doesn't make sense to buy brand new because it's not really doing anything different. In Ontario, it makes sense to build brand new because you got to charge market rent without having to worry about transitioning tenants out. But here you get that. So follow along for more.